All right, Chapter 6. Chapter 6, this means that we are halfway through the semester. We've already taken test number 1 and then the midterm, so we are in the second half of the semester now. So congratulations on making it through so far. Several of you have A's in the class right now, so congratulations to those of you with A's. And there's a few of you with really high B's, right on the cusp of getting an A. And as long as you work hard the second half of the semester and study hard, I'm sure that a lot of you can bring your grades up to where you want them to be. But this is Chapter 6. It's Fundamentals of Product and Service Costing. So we're going to have an overview of alternative cost systems for product costing and service costing. And they're going to describe details and extensions to the basic models that we've already covered. We're going to go into more detail in Chapters 6, 7, and 8. In this chapter, we're going to look at the fundamental themes underlying cost systems. We're also going to look at overhead cost. That's going to be a big part of your homework. We're going to look at how overhead cost is allocated. And we're also going to do a problem using a two-stage allocation system, which can get kind of difficult, but I picked some of the easier problems to do in the homework. So bear with me, the concepts can be difficult. A lot of students find this chapter difficult, but if you break it down piece by piece and understand it, then the chapter isn't going to be too difficult. All right, so when we talk about a cost management system, there are two characteristics that a good cost management system is going to have, and they are that one, the system has to be oriented to the needs of the decision makers, and two, they're designed so that benefits exceed cost. So what does that mean? A cost system has to provide information that's useful. So let's use the example of something that I learned in class when I took this class. But my teacher asked me about a pencil. Okay, what is a pencil? It's something that you write with, right? It probably lasts you, if you don't write with it every day for 8 hours a day, it could last you, I don't know, a year or 2 years maybe. It just depends on how much you write with. But a pencil is technically considered what? Is it an asset? Is it a liability? Is it an expense? In the sense, it's an asset, right? An asset is something that is going to provide you with use for a long period of time, and a pencil can definitely last for a while. And the other office supplies can last a while too. If you think of staplers or waste baskets or something like that, they can last you several years, right? But what do we do when we buy an asset? Generally speaking, we have to depreciate it, right? So a pencil is an asset. Should we depreciate a pencil? Probably not, right? Because a pencil is pretty cheap, and the cost, you're going to have to hire an accountant to keep track of your books and records. Are you really going to hire an accountant and pay him or her to keep track of the depreciation on a pencil or a waste basket or a stapler? And the answer should be no. So, office supplies are technically assets, like I said, but their costs are pretty low that you're not going to pay someone to keep track of that depreciation. So again, that goes to both of these keys to a good cost management system. number one, does a manager really need to know the depreciation of a pencil or a wastebasket? Probably not. That's not going to change. That's not going to have an impact on any decision that a manager has to make. And two, is it cost efficient to depreciate a pencil or a wastebasket? Is the benefit that you're going to get from depreciating these items going to exceed the cost? And the answer to those is also no. Now, keeping track of depreciation on a pencil or a wastebasket is not going to provide you more benefit than what you're paying to your in-house accountant. So again, you have to always look at the costs of doing something and the benefits you're going to get out of it. And if you're not getting at least equal benefit, then you don't. You probably need to make a different decision. Managers have to make a lot of decisions regarding how to run a company. That includes what items to sell. Stores, convenience stores, department stores, they have a wide number of products generally, and depending on what the data shows them about the cost, revenue per item, they're going to make a decision whether or not to continue selling a product or to get rid of it. Not only what product needs to be sold, but also the price that the product should be sold at. Also, a good cost management system is going to tell you how much each item cost you, and how much you're expensing, and how much is in current inventory. So there's a lot of information that managers need when they're looking at their cost management system, and the cost management system needs to give them the information that's pertinent to these answers. Cost allocation. So we've already seen these cost pools in the previous chapters. We have direct materials, direct labor, and manufacturing overhead. This is a chart that just shows visually that there's a difference between direct materials and direct labor versus overhead. So for direct materials, you can trace it directly to a certain product. Right, so we traced these direct materials to the alpha product as well as to beta. Okay, for direct labor, also it's direct, so we can directly trace it to each product, to alpha and to beta. Okay, but when we look at manufacturing overhead, that's an indirect. Those are indirect costs. So when we're talking about materials, maybe let's say whatever kind of items you're producing, let's say that they use screws and nails and other little hardware that that's so minute that you're not going to waste time and effort into tracking each little nail or each little screw that goes into each product. So you might classify that as overhead. Also, there's labor that can be considered indirect. So when you have indirect labor, that's something like maybe the factory supervisor or quality control, something like that. Something that you can't trace directly back to a certain product. So that's all this chart is showing you, that there are some costs that are directly traceable and some that are indirectly traceable, and the indirect ones are classified as overhead. Basic cost flow model. So one thing one important concept that we're going to practice on in this chapter is inventory. If you recall, inventory is a type of an asset account. All right. So inventory, if you are a store or a convenience store or a department store, you're going to have one inventory account, generally speaking. If you're a manufacturer, however, you're going to have three. You're going to have raw materials, work in process, and finished goods. So you're going to start out, let's see, we're going to have materials, we're going to have work in process, and finished goods. So materials, you're going to put your materials first in that account, in raw materials. Then you're going to add labor to that, and when you do that, you move it over to the work in process account. And then finally, when the item is complete, then you move it into finished goods, which means it's ready to be sold. Right. So in a perfect world, I suppose manufacturers could create these products all in one day. So they start in raw materials, you move it over the same day to work in process, and by the end of the day, you have them in finished goods. And that would make things a lot easier to account for. You don't have to worry about beginning balances and ending balances for materials or work in process. But unfortunately, the real world doesn't work like that. So you might have some materials here on day one, and then you transfer them over to work in process when you start working on them. But then maybe they're not quite done. Maybe they're 50% done, 60% done. So they might sit in work in process for a while. Or maybe you get a few 100% complete, so you transfer those few into finished goods, and the other remaining unfinished inventory stays in a work in process. So those are some details we're going to have to pay attention to in future chapters. For the homework for Chapter 6, I picked up problems that I think all the problems had zero beginning balance on these inventory accounts. So it makes it a little bit easier for us, but again, just be aware that some accounts in your future homework, they might have beginning and ending balances, so we have to make sure to take those into consideration. So here's an example of a paint company. It says that Baxter Paint begins production on April 1, and it starts and completes production of 100,000 gallons in April. So it starts and it completes. So that's nice. That means that there's nothing stuck in work in process, right? Everything is 100% done at the end of the month. It says that there is no ending work in process inventory. So that makes it a little bit easier for us to calculate. It tells us that we used 400,000 of materials, 100,000 of labor, and 500,000 of overhead, with a grand total of $1 million of resources used in April. So this slide shows us the data for our work in process account. So our work in process T account will look like this. We had a beginning balance of 0. We transferred in 100,000 gallons. Then we transferred out 100,000 gallons. So at the end of the month, we have 0 ending balance. Now, what happens to these work in process? They get transferred over to an account called finished goods. So finished goods will have the 100,000 in their account at the end of the month, and it's written out here that the transfers out go to finished goods. So what information do we know so far? We know that we spent a total of $1 million of resources. Remember, we spent on labor, materials, and overhead. We know that the materials, the work in process, were 100% complete, and when they're complete, they get transferred to the finished goods inventory account. We also know that 100,000 gallons were produced. So when we take $1 million divided by 100,000 gallons, then you get $10 per gallon as the cost. So now the book throws an extra wrinkle at us to consider. On the prior slide, remember, Baxter Paint had created 100,000 gallons of paint, and those gallons of paint were started in April and they were finished in April, so it was very easy to account for all of that paint. But now they're going to make it a little bit more difficult for us. Now they say that we started 110,000 gallons of paint. So we started a few more than we did in April. All right. Now, out of that 110,000 gallons, only 90,000 were complete gallons. Okay, so if you had a bunch of that's not a good-looking paint can, but let's say you have a bunch of paint cans. A few of them were filled up to the brim. Well, not a few. Most of them were filled up to the brim. But it's saying here that not all of them were. Some of them were just filled up halfway or 50%. It says that they were 50% complete. So, so you have to take that into consideration. How many out of the 110,000 gallons that you started, how many were complete? 90,000 were filled to the brim and ready for sale, and 20,000 of these gallons were only half full or 50% complete. So how does this affect your work in process inventory? Well, we know that we started out with 0 in beginning balance. We started 110,000 gallons. So let's say we have 110,000 paint cans, and 90,000 of these paint cans were complete and ready for sale. Unfortunately, 20,000 didn't get done. So now we have to do something called an equivalent unit. We have to calculate equivalent units. So if you're making, if you have 20,000 gallons of paint or paint cans, but they're only 50% complete, that means that you really only have 10,000 equivalent units of paint cans. Right. So what does that tell you? It says that you made 20,000 half gallons, but you could have made 10,000 full gallons. So I know in the real world there are other complications why you can't do a straight conversion like that, but fortunately we're not in the real world at the moment. We are in Chapter 6, and Chapter 6 tells us that if we have 20,000 units that are only 50% complete, we could have spent our effort on just 10,000 of those units and made them complete. So again, the equivalent of 20,000 gallons that are half complete would be 10,000 units. So this slide just shows what we just talked about. We have 20,000 gallons of paint that are partially complete. So we're going to convert these 20,000 half gallons So again, the math here is we're going to take our 20,000 half units, so it's 20,000 times 50%, so we get 10,000 equivalent units. So we finished 90,000 gallons of paint completely. We have 10,000 equivalent gallons, because remember that 10,000 is actually 20,000 gallons, but they're only half full. And so that gives us 100,000 gallons of paint. So it looks like for May we did 100,000 gallons of paint, just like we did in April. So for this month, instead of $1 million, we spent $990,000 on materials, labor, and overhead. So when we're trying to figure out how to allocate the costs of the gallons of paint produced, remember that we have to divide by 100,000. And remember, that's equivalent units. Okay, so that comprised of 90,000 completed units and 20,000 partial units. But we multiply that 20,000 by 50% and we get 10,000. So when you do 90,000 plus 10,000, you get your 100,000 gallons. So for May, like the prior slide showed, direct materials, direct labor, and overhead added up to $990,000. So where do we have to put this $990,000? Well, 90% of it goes to finished goods, okay, and then the other 10%, the 10,000 equivalent gallons, that's going to be reflected under work in process inventory. So again, whenever an asset is complete, it generally goes to the finished goods inventory. But if it's not complete, it'll go into work in process.